So what else can we expect from the rest of this earnings season? Well, joining me now from Singapore is Michael Preiss. He is Chief Equity Strategist at Standard Chartered. Great to have you on the program, Mike. So tell us, I mean, from what you've seen so far, what do you think and what are you expecting from this earnings season?
Well, it's quite interesting. Mostly, it's still very much a momentum-driven market. I mean, the first week of the earnings season was actually somehow disappointing. I mean, top-line growth was almost like expected. Companies beat expectations, but the guidance is a little bit where we saw a problem, and the market reacted accordingly. And then later on, of course, the potential S&P downgrade of the United States, the outlook, and so forth, seemed to reconfirm that the market is actually trading mostly of macroeconomic data, not really earnings data yet. And we feel that the second quarter slowdown potentially is not fully discounted yet. So that's why recently we changed our view on US equities from previously overweight to now neutral, precisely because we feel that a lot of the good news is priced in and a lot of the challenges potentially are still underestimated.
So you've changed your outlook for Asia and the US, you say, to neutral for the next 3 months.
Correct, on a 3-month view.
But you're still overweight for the whole year.
That's correct, yes. Partly because we feel that ultimately, I mean, we are reluctantly bullish in equities, because if you look at the alternatives, that is cash, in most countries you have negative real rates. Also, the bond market potentially is not attractive at these levels. So equities is the preferred asset class for the long term. However, in the short term, we feel that the market has potentially gotten ahead of itself, and also somehow the technicals seem to get worse. And again, as I said, it's not really trading off earnings, it's mostly trading off momentum. And what's really driving the global equity market is actually US dollar weakness. And this is where we expect the dollar to rebound in the second half, and with that we also feel some headwinds in the equity market is coming, because currently it seems to very much like a one-sided trade, sell the dollar, buy all risky assets and global stocks.
How big is the headwind of QE2 coming to an end? Is that already priced in?
I mean, in our view, it's not really fully discounted, but I think that is something we should not underestimate. And again, maybe that S&P news the other day is to some extent forcing the government in Washington to look at these things more seriously, because I suppose everybody is worried about US dollar weakness. And look at gold, look at silver, look at equity prices. It all seems to be driven by the very cheap cost of funding and the weak dollar.
You mentioned commodity prices there. Let's just come back to earnings for a minute. One of the themes seems to be margins under pressure. Companies coping with it okay so far, but going forward, they're a bit more cautious, aren't they, on their guidance?
That's correct, and this is why we, with the stocks that we cover, we have across the board actually lowered price targets, because we feel that a lot of stocks need to reflect those headwinds and those margin compression more. And again, the companies that we like, that we have on our high conviction list, are those with global brand names and that have pricing powers that can maintain margins, because the so-called global consumption tax is increasingly being felt, and sooner or later will show up in valuations.
Michael, tell us who those companies are that are on your conviction list, and also please tell us about a couple of companies that you've had to downgrade because of this inflation problem.
Okay, let's start with the downgrades. The most promising one was basically the Singapore property sector, where we lowered our target prices because we feel that interest rates are rising, and this is not really reflected in valuations either yet. That's why we lowered our target prices on Singapore real estate funds and so forth. And that also is with regards to property stocks across the board in Asia. But sectors we like still is, to some extent, still the resource sector, because ultimately supply shortages is one, but also the low cost of money and the fact that the US government sooner or later will have to monetize its debt is leading to the commodity boom. Short term, I think we're a little bit ahead of ourselves, but longer term, commodity stocks is perhaps one of the best areas to be invested in for the long term investor.
Michael Preiss of Standard Chartered, thanks very much for sharing that with us.